Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Christy Akulian, Director on BlackRock's iShares Investment Strategy team. We're talking about the market outlook and investing strategies for 2024. Christy, welcome back. So nice to have you back on the show.
Thanks so much for having me, Neena. This is great. Excited for the conversation.
Yes, likewise. So stocks, bonds, and many other asset classes have posted their biggest rallies lately, mainly on hopes that we are at the end of the Fed's hiking cycle and the central bank will start cutting rates next year as inflation appears to be under control and the economy remains rather resilient. So CME's Fed Fund futures are currently pricing in about 125 basis points of rate cuts next year. Is that too optimistic in your view? How many rate cuts should investors expect in 2024?
Starting out with the hard questions right away. I like it. Yeah. So our view at the macro level pretty broadly is that there probably will be some cuts next year, but we don't expect those to come until the second half of next year. So I think it kind of the high level, what we can say right now is that it feels like the market is anticipating more and faster cuts than we think are actually going to materialize. And I think it's really important to think about the way that the Fed hiked rates and how quickly they did so is probably not going to be how they're going to cut on the other side. I think what we've seen more recently in terms of like a hike and then a pause and a hike and a pause, we think that we'll certainly see a cut and a pause, but I think they're going to take their time to do so. I think that, you mentioned we've seen such a strong rally in stocks and in bonds over the last month. November was a great month for risk assets and in general. But, I think a lot of the soft landing narrative that we maybe were talking about in the summer has kind of replaced the higher for longer narrative that we talked about in the fall. And that spurred some enthusiasm. I think that the market may have gotten a little bit ahead of itself if they're really only looking towards, the Fed and when cuts are going to come. So yeah, we do think there will be some cuts, probably not as many as the market expects right now.
Interesting. So higher for longer. So one of the biggest market stories this year has been investors' flight to cash. Investors continue to pour a record amount of money into cash-like instruments, and that's mainly due to yields which are close to 5%, and there is very little risk in these instruments. But many investors are realizing now that while they were hiding in the instruments that paid 5% yields, they probably missed 20% plus returns on stocks. So do you think that some of that money will be withdrawn as investors try to chase the equity rally? And could you talk a little bit about the opportunity cost that investors face?
Yeah, I think this is the central question for 2024, right? As you mentioned, we saw a record amount of inflows into cash-like funds. We saw $1 trillion put into money market funds this year. I will acknowledge that some of that came after the Silicon Valley Bank and kind of the banking crisis. And when we actually saw a lot of money come out of deposit accounts and into money market funds. So almost weirdly like a risk on cash trade, if you will. But outside of that, even we've just seen so much money allocated towards cash, and maybe done so in a deliberate kind of asset allocation way too. And I think that obviously that made a lot of sense on the fixed income side to stay in kind of the very front end of the curve in short duration, even in cash in some instances, when the Fed was hiking as aggressively as they were, right? So, again, $8.3 trillion worth of cash on the sidelines. We're near a record in terms of money market assets. The way you put it is, what is the opportunity cost? I think that's exactly the way that investors are thinking about it. They have thought about it over the course of 2023 as, 5% risk-free. but risk cuts in both directions. And we're really convinced, and we believe that in 2024, the bigger risk is sitting out for a lot of this, particularly on the fixed income side. To your point, if you sat out at the equity markets this year, as everybody coming into this year expected a recession, you really paid the price for that. And so, I think our guiding principle is staying invested, but doing so in a way that makes sense, right? And on the equity side, we still think that you can see a positive year next year, maybe modestly so or less so than this year, but still positive. And so we do think that investors should remain invested there. On the fixed income side, though, I think that there is so much more urgency around stepping out of cash and extending into duration. So kind of what we wrote about in our 2024 outlook that just came out is really that risk and that opportunity cost. And one of the analysis that we did here that I think is really important and really telling, and we put it on the front page of our report. We looked at we looked back to 1990, and we looked over the last 5 Fed hiking cycles. And what we did is we divided performance up into the 6 months leading up to the last Fed hike, and then the period from the last hike to the first cut, and then the 6 months from the first cut and going forward, right? And so we've got these 3 distinct time periods. And I think that the conventional wisdom has always been that you kind of for the Fed to start cutting rates, and then that's when you get this really strong performance. And in fact, what we found is that the best performance is actually in the pause period. So between that last hike and that first cut. The difference is most dramatic in fixed income. So kind of unsurprisingly, like a bit as we would expect, both stocks and bonds outperform cash in the pause period and in the cutting period. But in fixed income in particular, you get almost twice as much of that performance during the pause period as you do after. And so I think that there's this sense, and anecdotally from the conversations we're having with our clients and with investors too, is that a lot of people are kind of sitting back on the sidelines and waiting for more clarity on the macro front before they want to put money to work. And our word here is that there's a huge opportunity cost to doing so, and that this pause period can actually be really profitable.
Very interesting. So investors should not worry about this pause period that you are expecting. So let's talk a little bit more about BlackRock's macro outlook, because as you mentioned, many investors are waiting for more certainty, more clarity. So does BlackRock expect a recession in 2024? And what are the other key risks that investors should be aware of?
A recession is no longer our base case. But we do think that growth is going to slow from kind of these breakneck speeds, over 5% for GDP in Q3. We don't in any way anticipate that we're going to continue at that rate. And so, I think it's important to talk about things in the recession or no recession or soft landing framework. But I also think it's important to acknowledge that the direction and kind of the rate of change matter, and not just the level. And so going from 5+% GDP growth to something more normal, like 2 or even sub 2%, and that slowdown, you can feel some economic pain even if we don't hit an economic recession. So I would say that we're overall cautious, but not necessarily calling for a recession.
So you mentioned earlier that stocks and bond returns have typically been higher during the pause period. And with the economy slowing down, what can investors expect from equity and fixed income performance in the new year?
Yeah, it's a great point. So like I said, I think we do see a path towards positive equity returns for 2024. Although we, probably high single digits, and not another 20% up type of a year for benchmark indices, right? So modestly positive. But I do think that there will be quite a few headwinds, and it maybe not just be a straight up slope to get there, right? So we see lots of cross currents in the market right now. So obviously declining inflation is a good thing overall. Obviously we needed to see that come down, which we have, and that is encouraging. We do, like I said, expect that interest rates will come down, which should be helpful for risk assets and some of the more beaten up parts of the equity market, although maybe not as much as the market anticipates. We've seen growth stay relatively strong. So again, lots of cross currents, particularly for equity markets. And so some of the ways that we think about investing in that environment and sort of positioning for macro risk or managing around them is we do still really like staying up in quality, particularly on the equity side of a portfolio right now. And there's specific reasons for doing so. So, we have been talking about QUAL, which is the iShares MSCI USA Quality Factor ETF. And, when we think about quality and the way that is defined, I think is important just to lay out here too, is that there's three components. One is profitability. One is consistency of earnings over time. And then the other one is a quality of balance sheet. And so low leverage is what we're looking for in the companies that sort of make up this index. And in particular, it was that last component, the strong balance sheets and the low leverage that was really rewarded in 2023, which makes sense, right? When interest rates are high and rising, you want to find companies that need to borrow less money. So I think that is the story that held true in 2023. That's contributed to the outperformance of quality relative to the broad index. And we think that will probably still be the case for at least the first half of next year. So on the equity side, we do think you should stay invested. We think you should go up a quality a little bit and kind of stay there until there's more clarity around the growth picture. I think on the fixed income side, this is still probably our highest conviction trade, and the level of yields it offers, great potential for future returns. And importantly, I think the current yield in this environment is no longer the best expectation of forward returns, because we also can factor in potential price appreciation as interest rates fall. So looking at the total return picture, you could see double-digit returns in even something like the ag. And so really importantly, and goes back to that idea of stepping out of cash, is we think investors need to extend duration, because cash can't participate in a rally like bonds can. And so, we do think that investors really need to get there. Something like the 3 to 7 year part of the curve is where we see the sweet spot for fixed income. There's still a bit of risk on the long end, where we think that rates could continue to move higher as the yield curve disinverts and returns to a more normal shape, and we see a positive term premium. And then the front end of the curve just doesn't get to participate in the rally as much that we think could come as rates do eventually come down. So something like the IEI ticker, the iShares 3 to 7 year Treasury ETF is sort of where we're focusing our attention right now, and in terms of capitalizing on some of those opportunities for next year.
So your QUAL ETF has been very popular with investors this year.
Yeah.
I noticed that it has taken in $12 billion year to date. And you mentioned the performance too. So these are all high quality companies with stable balance sheets and very low amount of leverage, as you mentioned. So companies like Apple, Microsoft, and NVIDIA, which are among the top holdings in this ETF. So I like this ETF. And in your note that you also mentioned that investors need to have a more dynamic approach to their portfolios in the new year, because as you talked about, there are going to be lots of cross currents in the next year. So could you talk a little bit about the different scenarios that investors could expect and what kind of investment approach they should take in those environments?
Yeah, I think that's so important. And, as much as we call this the 2024 outlook, we have every expectation that, the market and the macro can change over the course and will change over the course of 2024. So I'd call these our views for right now. But you said this, and I will reiterate it. We think it's so important to be nimble in this environment, because we can change. We can see changes in rotations in equity leaderships. We can see changes in fixed income and yield opportunities. And so we think of this as being a year to pick your spots, right? And so I think that the two examples I gave earlier on the equity side and the fixed income side are really important kind of core holdings in a portfolio, and we think those can be really useful building blocks. We also see opportunities in for example, in some active management, and picking your spots, and again back to that idea I'll give you one example is BINC. We call it BINC, BINC. It's the BlackRock Flexible Income ETF. And this is one example where, active management in particular, so this is a core plus fund. So it is, it's managed by Rick Reeder and team, and what he can, what him and the team can do and where they can go invest is internationally. So we see opportunity right now in emerging market debt, for example, or we see it in some of the valuations and securitized products. And I think that a fund like this is a great opportunity of taking advantage of changing macro environments, but almost just outsourcing this to a high conviction active manager. And so being able to seek out those yield opportunities that these cross currents are going to create this year. So I think that's one example of how we see it. And then in terms of kind of the I think you talked about the scenarios for what we could see playing out later this year. One big one is that we could see a broadening out of equity leadership, and if we do see, the market and on the equity side at the index level trend higher, then we could see more participation from some of the laggards that really struggled in 2023, right? So things like small cap and things like value and specific kind of sectors and industries within it too. What I would caution is, we're probably not there just yet. So this is almost the next trade, if you will, once we do get a little bit more clarity that inflation can continue to come down, interest rates can come down, but growth can remain positive.
So now let's talk about some themes for 2024. And this has been a great year for AI-themed stocks. And AI-themed stocks, we know that they drove the market rally this year. And it seems that optimism around AI is back again today. As we are recording on December 7th, Alphabet is up about 6% today, after Google released Gemini, their AI model, and AMD is up about 9% today after the release of their AI chips. So tell us about the themes which you believe can be successful in 2024.
Yeah, that's a great point. We have a lot of research and we've published and we've talked a lot about mega forces. And I kind of think about those as almost being the drivers of returns that are outside of the macro, if you will. And you absolutely hit the nail on the head that AI was such an important one this year. We're believers in AI. We do think that this is not hype, that this is reality, and that this really can impact a company's bottom line and just improve productivity, right? So I think that there is a very long runway for AI investing. We do believe that again will broaden out from just the small handful of companies that have really benefited from that so far, and broaden out to include kind of the full value chain of companies that are involved in creating and producing AI. So we have one fund, IRBO, which is the iShares Robotics and AI ETF. We've had so many conversations around this. It's taken in large flows this year. Even just things like how many times that web page has been visited on our website. I think it's the second or third most popular page on iShares.com after IVV or S&P 500. So you can tell that there's a lot of interest. A lot of people are learning about this, and we've probably started to see the beginning in terms of flows and allocations there of very specific AI trades. So I think that can continue. And then another one, that we've talked about, I won't go into all the mega forces, but one that I think is really starting to come to bear in terms of how we're seeing people invest is really just around demographic changes. And I think that was, and getting a little bit more granular in terms of how they think of their international exposure. So we're having less conversations that are about EM versus DM, and we're having more conversations that are about, China versus India. Or we're seeing investors embrace a more granular approach to these portfolio allocations. So emerging markets ex-China, as EMXC is one of our funds, has been one of the more popular international trades. And I would say too that it's not just a divestiture, it's kind of a portfolio construction. Do you want to size up or down certain exposures within your portfolio? Do you want to go active, or do you want to use an index for certain parts of it? And so just having more levers to pull by having more granular exposure in the first place has been really helpful. And I think the demographics, change that we expect, this mega force that will frankly play out not just over years, but probably over decades as well. We're seeing investors start to move behind that. And I think some of it is geopolitical concerns and fragmentation, but yeah, just a lot of demand and interest in things like single country funds and moving a little bit more regional as opposed to just, broad economic development zones.
Very interesting ideas. Both India and Japan, those ETFs have done quite well this year. Now, going back a little bit to fixed income outlook. So you talked about IEI. So we saw very interesting trends in fixed income ETF performance and flows this year. So many investors favored ultra short bonds and ultra short bond ETFs, as we discussed earlier, but many others were looking to lock in those their rates, and they were trying to buy the dips in long-term bond ETFs like TLT. TLT was a big story.
Yeah.
The ETF was underperforming as rates were rising, and investors continue to buy all dips, and they continue to pour a lot of money into that ETF. So you think that it is still too early to extend duration?
Yeah. So, I think TLT, it was the trading volumes, it was the flows, it was the options around the fund too. There's been a lot of that. It's exactly what you were saying, a buy the dip mentality. And so I think investors just saw how negative performance had been and how influenced by rates moving up that had already been, and we're looking for an entry point. So our view right now on this is that we do think investors need to extend duration, right? I think that is our first starting point. But our secondary consideration is that where you get your duration matters, right? And so different points upon the curve, we see different risk reward profiles. That said, though, we know investors aren't starting from scratch. They have an existing portfolio. And so TLT and really like long duration type of exposures have been a very easy and capital efficient and liquid way for advisors and for investors to increase duration in a portfolio really quickly, right? You just need a little bit of TLT within a portfolio to bring up the average duration in your fixed income sleeve pretty meaningfully. So small amount of money goes a long way, a lot of bang for your buck there. So we have seen that approach taken by some investors who, maybe really still like the front end of the curve for the, higher yields that they have there, and then pair that with a barbell strategy in TLT. That is one way to increase duration. And that if that works for you, that is one thing. Our preferred way is still to get more to the intermediate part. And part of it is just, from what we published and from our views, long duration we're actually neutral on right now. So we used to be underweight and we moved to neutral. So I think that the yield curve disinverting quite a bit this year was really important for that. But that said, we do still think that there are some risks ahead for the longer end. I think that's where we're going to see a reflection of the deteriorating fiscal condition in the US, and obviously the amount of treasuries that are going to need to be issued to manage around the US deficit and things like that. I think we're going to still see investors demand a positive term premium. So they're going to demand a higher yield for holding longer term debt than shorter. And we've seen that normalize to some extent, but term premium is only back to about zero. It was deeply negative for the last few years. It's about zero now. We think that it can and will move positive. So it's not that we don't like the long end of the curve. It's just that we think that there may be better entry points throughout the course of this year.
That's quite helpful. So now switching gears a little bit, I wanted to talk about ETF flows, and they have been quite interesting this year. And I know that you monitor ETF flows very, very closely.
Yeah.
So let's talk about those trends a little bit. So earlier this year, ETF flows were rather lackluster, but in November, US listed ETFs gathered more than $100 billion of new money, which was quite interesting. So tell us about your key takeaways from fund flow trends this year.
Yeah, no, that's a great point. We love flows. We publish a lot about flow and tell, sort of our riff on show and tell from elementary school, right? So I think you're exactly right in that even though equity performance was strongly positive this year, because very few people anticipated that, I don't think that quite as many people participated. We still tended to see flows look relatively risk off or a little bit tepid, even on the equity side for most of this year. So we didn't necessarily see the same amount of performance chasing in terms of flows throughout the entire year that we might have expected to. So it was a muted year, if you will, for flows. November was a real change in that. And after the pain that investors felt over the fall, and maybe some of that higher for longer narrative that was really dominant in September and October, and the poor performance that we saw, investors came back in November, and I think that there was a decent amount of performance chasing as stocks and bonds both rallied. I think that, even just kind of stepping back a little bit and not just thinking about the changes month over month and things, but looking at the big picture of what we've seen in ETF flows, one of the more interesting trends that I have seen from this entire year that I will take away into next year is investors are really embracing alternative types of funds and alternative types of strategies. 24% of all ETF flows in 2023 so far have gone into active ETFs. So I have to imagine that is at or close to a record. I don't have the historical data, but I do think that we're seeing investors think about ETFs as a vehicle and using them in new and different ways, which is pretty cool. That's encouraging to us. It's not just a buy and hold index product. We're seeing lots more applications and much more embrace and willingness to think about more, targeted outcomes. For example, we've been talking about some of our buffered ETFs or our buy right strategies. And I think that is really going to be a trend that carries us into 2024 and beyond.
Excellent stuff, Christy. We'll have to leave it there. Thank you so much for joining us today and for sharing your insights.
Absolutely. Thanks for having me.
That is Christy Akulian from BlackRock. Now let's quickly recap some of the ETFs that we discussed. For quality, we talked about QUAL ETF. It is the iShares MSCI USA Quality Factor ETF. For robotics and AI, the ETF is IRBO, the iShares Robotics and Artificial Intelligence ETF. She mentioned Japan and India. The ETFs that are worth a look are EWJ, the iShares MSCI Japan ETF, and INDA, for India, the iShares MSCI India ETF. Now, on the fixed income side, we talked about the actively managed ETF. It is the BlackRock Flexible Income ETF, ticker symbol BINC. And for the intermediate duration bond ETF, the iShares 3 to 7 year Treasury bond ETF, ticker symbol IEI. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.